Stop loss hunting, the market's old game against impatient traders. The price has been hovering near your stop loss for a few minutes. It moves a little closer, then pulls back, then pushes in again. You're staring at the screen, and one sentence keeps looping in your head. What if it tags my stop exactly and then reverses? A few moments later, that's exactly what happens. The price spikes, hits your stop in one quick move, and you're out of the trade. Before you're even fully out of the shock, the price turns around and starts moving perfectly in the direction of your original analysis. This is the moment many traders say, "The market hunted my stop." But there's a more important question. Was the market really hunting your stop, or did you place your stop right where everyone expected it to be? In this video, we're going to look at how stop loss hunting actually happens and how you can avoid falling into that trap so often. Part 1. What does stop loss hunting mean? Stop loss hunting is when the price moves into an area where a lot of stop losses, pending orders, or emotional decisions are clustered, quickly sweeps in through that zone, and then reverses. This happens most often around very obvious levels: highs, lows, supports, resistances, daily highs, lows, or big round numbers. For example, everyone sees that the price has bounced off a support level several times. Many buyers place their stops just below that same support. If the price dips a bit under the level, a lot of stops get triggered at once. Then the price may bounce back up. To a new trader, this looks cruel and unfair. But from a market structure perspective, that zone was full of liquidity. Part 2. Why are impatient traders more likely to get hunted? Because impatient traders usually place stops based on fear and convenience, not on market logic. They want the stop to be tight so the loss is small, but when the stop is too tight, normal volatility can hit it easily. On top of that, impatient traders often enter the very first reaction in the price. There's not enough confirmation yet, the structure isn't fully formed, but they jump in because they're afraid of missing the move. The result is simple: early entry, tight stop, and exit before the real move. Stop loss hunting is not always about bad luck. Very often, it is the result of a mix of impatience, obvious stop placement, and entering without a proper confirmation. Part 3. Signs of a poorly placed stop loss. There are a few simple warning signs that your stop is sitting in a vulnerable spot. It's placed exactly behind a very obvious level. It can be triggered by the smallest candle wick. Its distance doesn't match the normal volatility of the market. It was chosen mainly to keep the loss small, not to respect structure. It's sitting behind a simple line, not behind a real market structure. A good stop belongs at a level where if the price gets there, your trade idea is generally weaker or no longer valid. If your stop is at a level that the price can easily reach without breaking your overall analysis, that location is probably not ideal for a stop. Part 4. How can we reduce the chance of being stop hunted? First, place your stop behind the structure, not just behind the line. If you're in a long, then stop should be at the level where if the price reaches it, the uptrend structure is actually damaged, not at a level where the price just slightly taps support. Second, respect the volatility of the market. Instruments like gold or highly volatile FX pairs needs more breathing room. If your stop is too tight, the idea might be right, but the trade won't survive the noise. Third, don't rush after the first break of a level. Often, the first breakout is only there to collect orders. Wait to see whether the price can hold and stabilize after the break or if it snaps back into the range. Fourth, adjust the position size to the logical stop distance. Many traders see a proper stop as a further away and still use the same large size. The correct approach is to reduce the size so the risk stays constant even with a wider stop. Fifth, be suspicious of very obvious levels. If a level is visible to absolutely everyone, there are probably a lot of orders sitting around it. That means the area can be easily swept before the true move begins. Part 5. Stop loss hunting is not always a bad news. If you look at it correctly, a stop run can actually be a useful signal. Imagine the price breaks slightly below a previous low, triggers the stops of many buyers, and then quickly snaps back above that low. That sharp reclaim can show seller weakness and a potential reversal. In different price action approaches, this behavior is described with terms like liquidity sweep, fake breakout, or liquidity grab. The key is not just to get angry at the move, but to ask, did the price only grab liquidity and then return? Or did it stabilize after the break or immediately reject and reverse? Did overall market structure really change? When you start asking these questions, stop-loss hunting stops being just an annoying event and becomes another useful piece of your analysis. Part 6. Summary. The market always likes obvious stops because that's where orders, liquidity, and emotional decisions cluster. If you place your stop in the same place everyone else does, the chance that it gets hit before the main move increases. The solution is not to trade without a stop and not to keep moving it away. The solution is to choose your stop more logically, avoid rushed entries, understand the volatility of your market, and size your trades according to the stop distance. A professional trader is not afraid of stop losses, they simply make sure that their stops are not easy targets for normal market noise. Think back to the last time your stop got hit and the price then reversed in your direction. Was the problem the market or where you placed your stop? Share it with us in the comments.